let's now bring in Helen. Good morning. Morning, Helen. Should be able to talk now. There we go.
Can you hear me?
I can hear you.
Excellent, excellent. Good morning, James. That was very interesting listening to your introduction there.
Good, thank you. So, Pantheon International, as usual, if you sort of set the scene with just describe what the fund's doing, please, that would be quite helpful, and then we'll get some questions.
Absolutely. Well, thanks very much, James. And yeah, I'll spend 10-15 minutes just giving a brief description of Pantheon International and an overview of the results, and then, clearly very, very happy to take questions. So just to remind everybody, private equity is investment in unlisted companies. Why be bothered about private equity? Well, public markets are shrinking in terms of the number of opportunities. Companies are staying private for longer and often don't go public at all. So to get access to some niche industry sectors and a lot of growth, which I'll talk about later, it's interesting to invest in private equity. Traditional private equity funds are quite difficult to access. They require high minimums. You've got to manage all the calls and distributions and cash flow yourself, and it's quite difficult to get access to the top private equity funds, and even harder to get into the direct investments, co-investments and secondaries, which we do. So PIP essentially makes all of this accessible. It makes the private public. It's an investment trust which was launched more than 36 years ago. So it's been around for a long time, been through lots of different cycles. And in that time has actually changed character a bit. Started out really as a fund of funds, but now, as you can see from this chart, over 50%, actually 52% of PIP's NAV is now invested directly into companies, into private companies. This is either through co-investments, where we invest into a company alongside one of our favorite private equity managers. And typically these investments don't carry any management fee or any carried interest, performance fees, so they're pretty attractive from an economic standpoint. And we also invest in single asset secondaries, what we call manager-led secondaries. So between the two, that's now 52%, and funds are actually in the minority. Just moving on to the stage of investment. So PIP is really a buyout vehicle. So these are control investments, more than 50%, where the manager and us alongside the manager are able to really determine the direction of travel of a particular company and influence what it does, even replacing the management team, determining strategy. So the buyout side of the portfolio is now more than 70%. We've got very little exposure to venture, it's only 3%. And this is the most volatile part of the whole private equity spectrum. It can work really well when it works well, but it can also work not so well. So 3% only in venture. PIP is a global vehicle, and it's weighted towards the US, which is the deepest, most sophisticated and most experienced private equity market in the world. We have a lot of sector-specific managers. Second largest region is Europe. And then in terms of those sectors, so we've moved the composition of the portfolio over the last 10, 15 years from a portfolio that was much more consumer biased, that was the biggest sector, to now one which is really tilted towards the more resilient and defensive sectors. So we have 33% in information technology, but I term this kind of boring tech. It tends to be things like enterprise software, particularly orientated towards SMEs. So things like legal software, accounting software, cybersecurity. And then we've got 19% in healthcare, and this is healthcare services and healthcare products, particularly those that serve aging populations. Again, it's a sector which is benefiting from long-term secular trends. And our third sector is consumer, but that's tilted towards consumer staples. So things like consumer services. We've got quite a bit in the education sector, for example. So overall, PIP's portfolio is really curated to work well in different environments, but we think it's particularly defensive and resilient in this particular environment. So maybe just moving on to the next slide, really talking about how the portfolio has performed in terms of the underlying performance of the companies. So you can see on the right-hand side here that our annualized revenue and EBITDA growth in the portfolio, and this is for the buyout investments, has been pretty strong. So the 5-year annualized revenue growth, 18%, 5-year annualized EBITDA growth, 20%. And that compares very well with the similar statistics for the MSCI World. And then, I'm going to talk quite a bit about value in the portfolio. And here you can see the sort of potential uplift. We're currently carrying the existing portfolio at a 1.6 times multiple of cost. But historically, when we exit companies, we generally gain an average multiple of 3 times cost. So that's a potential uplift there in the portfolio, which we hope to be able to capitalize on for shareholders. So that's all about the growth and the potential. What about the risk? Well, in terms of the loss ratio, it's an extremely low loss ratio. The loss ratio over the last 10 years is only just over 2%. And even if you took this back to the great financial crisis, it would still be less than 3%. So we think that this is actually a very safe portfolio and highly diversified. And just talking about the earnings in the portfolio, 94% of our direct company investments are actually EBITDA positive. So that just sort of underlines the fact that this is a growing and very resilient portfolio. Next slide, please, James. Now, I talked about embedded value, and this will become important when I mention what we're doing in terms of buybacks, actually. But the value-weighted average uplift on our exits for the last year was 27%. So this is the cash that we receive versus the last full holding valuation of a particular company. And on average, across all the exits in the last year, it was 27%. And that's pretty much in line with what we've seen in the past. You can see the history here going back to 2012. Our average uplift has been around 31%. And I mentioned earlier that cost multiple on exit, it's 3 times for the most recent period. And you can see again, that's very much in line with the past. Distributions were lower last year because there's less M&A activity, but the distributions that we did get, the exits that we did see, were at these very healthy uplifts and multiples. Next slide, please. So that brings me to performance for the year. So we've just, wrong slide there, not to worry. Maybe just talking about the exits that we've achieved during the financial year. So we exited a number of different companies, but 3 here that we just wanted to highlight. One that I think everybody will know, Interactive Investor, which was a highly successful deal for JC Flowers. We bought this company through a secondary, actually, and it was acquired by Aberdeen. One that we did as a co-investment, so investing directly in the company alongside one of our private equity managers, HG, which I know a lot of people will be familiar with, a company called Medifox in the healthcare area, supplies software solutions for clinics, elderly care homes and medical practices actually in Germany, in the DACH region. And that was exited at a very healthy 4.1 times actually original costs and 40% IRR, and it was sold to a strategic buyer. And actually strategic sales, as sort of Aberdeen and ResMed might be termed, account for 55% of our exits. And then the other big exit route for us is secondary sales. So in fact, the first company, K2, was sold to a private equity buyer, Warburg Pincus, and that's another very good exit route for us. IPOs only account for less than 10% of our exits, so we're not reliant on them. So next slide, please. Sorry, here are the performance numbers for the year. So this is 31st of May, the most recent annual results. And you'll see there that we had reasonably good NAV per share growth, despite everything that's going on in the environment. And you can see the longer term performance there in terms of NAV per share since inception, so 36 years, 12%, and actually a wee bit stronger over the last sort of 3 and 5 year period. Over the same period, the share price did not perform as well as the NAV. And in fact, we saw a derating in common with the rest of the private equity sector, which has really been out of fashion, I would say, for the last year. So in common with other others of our peers, our discount widened pretty strongly over the period. And that brings me to probably the biggest news. Next slide, please, James. Actually, sorry, in terms of the portfolio, just a little bit more detail before I talk about the news. So in terms of digging into the valuation movements, you'll see there that our buyout portfolio on the right-hand side performed pretty well. So small mid-market buyouts were up 10% in the year. The large mega were up by 4%. What took us down a little bit was venture with negative 21%. That's only 3% of our entire portfolio. So it was a detractor, but it was limited, and similarly growth -6%. But really, counterbalanced by that good performance from buyouts. And then on the left-hand side, NAV per share movement, you'll see that valuation gains were positive in the period. We had a bit of a negative impact from Forex because PIP is a global vehicle. When the US dollar strengthens, we benefit. When it weakens, we don't benefit, and that's what really happened in the period. So overall, that 2.4% NAV per share movement. Sorry, next slide, please. So I talked about the fact that NAV per share movement was reasonable during the year. We've got a NAV of around about 2.5 billion, but sadly the share price did not keep up with it, and the discount widened to in excess of 40% during the period, in common with other vehicles in the sector. As a result, and it seemed to us that this was presented a very large opportunity to acquire our own shares in a portfolio that we know very well, where we believe that not only we believe in the current NAV, but we believe actually that there is good embedded value in that NAV. And therefore, the board has made the decision to commit up to £200 million during this financial year, which will end 31st of May 2024, to acquire shares. And we've actually already kicked off that buyback program and have been active in the market since we announced the results on the 3rd of August. And PIP's allocation policy will actually be extended for future years as well, so that we will dedicate a portion of the net cash, which is generated by distributions from the portfolio, to share buybacks in the future. And we'll be announcing details of that in due course. And just really to sort of drive it home, we do know the portfolio very well. We've got a lot of confidence in the valuations, and therefore this seems like a good opportunity, and we will create good value here for shareholders at these discount levels. And we've got the ability to do it because PIP is in a very strong financial position. We have cash on the balance sheet. We have a completely unused credit facility of £500 million, and therefore we are able to buy up to 15% of PIP's year-end market cap. We will also carry on with our investment program, investing in exciting, interesting positions that we think will be able to create value longer term in the future. We've got the flexibility to do this because PIP invests directly. For the most part, PIP is actually making those direct investments into companies, direct investments into funds, and therefore can vary its deployment and can vary what it does on the investment side according to where the opportunities are. Next slide, please. So despite the market conditions, we achieved positive net cash flow during the year, and you can see that on the bottom chart. In fact, over the last 10 years, PIP's portfolio has generated 1.7 billion of cash. So that's an average of about 170 million per annum. So this is the cash that will be used in the future, not just for new investments, but also in terms of buybacks. And you can see our distribution and our core rates there at the top. Next slide, please, James. So I mentioned our financial strength. This is a summary really of the situation at the end of June, which was the last numbers that we announced. So we still had £60 million of cash on the balance sheet. We still have a completely unused facility. And by the way, that was renegotiated last summer and expires in July 2027. So we've got a great deal of capacity there. And if you look at the balance sheet, you look at the portfolio, the available financing, you look at the undrawn commitments, we have an undrawn coverage ratio of 100%. So we really are in a very strong position, not only to cover our undrawns, but also to be able to execute on this buyback program. Next slide, please. So in conclusion, just to wrap it all up here, PIP has been around for a long time, 36 years, has registered very good long-term outperformance over public markets in that time, so 12% net of all fees, annualized NAV growth. You can see that from time to time, the share price becomes disconnected, decorrelated from the NAV. That's very clear if you look at the 22-23 period at the right-hand side of the chart, where you can see that the NAV has progressed and now has just sort of leveled off, but the share price has taken a very big dip and has given rise to this large discount, which we will seize the opportunity for, given the fact that we are able to acquire our own shares and create that value uplift for our shareholders. So with that, maybe I'll leave it there, James, and hope I haven't gone too far over time, and ask if there's any questions.
There's lots of questions. Thank you very much, Helen. That's good. Right, so where should we start? I think in terms of the allocations first, should we go back to that slide? There we go, that one. I suppose there's some questions really about why you do things that well, I guess if something doesn't work, people go, why are you doing that? So the venture is one of the things that people are questioning. What's the attraction to venture investing? Has it worked over the time that you've been doing it?
Yeah, it's a great question, actually. So the answer, yes, it has worked over lengthy periods of time. That venture allocation is not directly into companies. That venture allocation is primarily through funds, and it's through the very, very top funds in the world, which we have access to. So, names that you'd be familiar with are groups like, Index Ventures, Accel, Andreessen Horowitz. These are invitation-only, completely access-constrained funds, and over time, they have produced extremely good long-term returns. But as I mentioned when I was going through the portfolio construction, venture can be very volatile. And you saw that in the last year. If you'd gone back to 2020, 2021, venture performed extremely well, extraordinarily well. So if you average it out over the long term, it's a good, interesting piece of the portfolio. However, we would not want more than a small slice because of the volatility. So we think between 3 and 5%. Maybe 2 and 5% is probably the right sort of level for us. But I did want to stress here that the vast majority of our portfolio is in profitable, growing businesses. This is really almost like sort of the cherry on the cake, the venture allocation. Does that help? Yeah,
definitely. This is a knowledgeable question here. So in your strategic review in 2018, you said you're going to de-emphasize secondary and special situations. So did that decision turn out to be the right one?
Yes, it did. So special situations, a lot of the special situations portfolio, just to take that one first, is in energy. This is a legacy part of the portfolio, which we are de-emphasizing. So we haven't made any new energy investments for several years now. Energy investments, apart from the ESG considerations, which we're very much alive to, because a lot of this is traditional energy. So things like, sort of energy extraction in the US. So from an ESG standpoint, we felt we weren't comfortable with it. But also from an investment standpoint, you're very dependent on commodity prices. And again, we're trying to reduce volatility in this portfolio. So hence the decision to de-emphasize energy. Now, clearly, in the last year, energy has actually performed quite well. So you've seen that sort of positive impetus to the valuation movements over the last year. But it is an area which is slowly decreasing.
To zero?
It'll probably get. I mean, it takes a while for these things to work their way out of the portfolio. I mean, it already is come down from, I believe it was sort of 8% a couple of years ago down to 3%. So I think it's very clear the direction of travel. And then in terms of investment types, so what we decided to do was to de-emphasize the LP fund secondaries. So the fund secondaries where we acquire a whole fund, a whole sort of portfolio of fund interests. So usually not just one fund, but several funds and all the underlying companies. Now, the problem with that for a vehicle like PIP is that it's immensely diversified, even over-diversified. And PIP is already a diversified vehicle, and we don't need to add almost sort of market beta to the portfolio by acquiring these highly diversified portfolios with lots of tail end interests. Much more interesting for us to acquire single asset secondaries where we can pick the asset, pick the company, we know the manager, we know the sector and the subsector that it's operating in. So that's been pretty successful. We've moved the portfolio in that direction. So the fund secondary part of the portfolio, that 14%, is now in the minority in terms of the secondary allocation. I hope that helps.
Yeah, definitely. And there's a specific question about what the return has been on the Pantheon Secondary Opportunity Fund. Do you have that information to hand?
I'm afraid I don't, James. And actually, it's quite a difficult question to answer because we've got, Pantheon, the manager, manages a whole series of different secondary funds. I think we're actually on secondary fund 7 at the moment. So it would depend which fund, which time period, etc. But so I'm afraid that's more difficult to answer.
Fair enough. In terms of the exposure to directs, is that still rising, and how far will it get to, do you think?
So we haven't agreed any limits with the board. And just to say, I probably should have said to start with, but the board is completely independent of the manager. So there's nobody from the manager that sits on the board. It is completely independent. We recommend our strategy to the board. They might make tweaks to it, and then they will ask us to implement it. So that's an important factor to stress. There hasn't been a target set, but I think you can see the direction of travel here because we've already got a third of the portfolio in co-investments, which are are directs. The single asset secondaries are rising, so that is another area of the portfolio which will increase. We will still make primary investments because, frankly, there are certain assets, companies that you cannot get to through either co-investments or through secondaries. So that's a valuable part of the portfolio that we would like to maintain, but no target set as yet.
Okay, thank you. One more specific question here. This is saying that you classify HG as a buyout fund and question whether it's really a growth fund. Is that true?
That's a great question, actually. So I think we would term them as a growth buyout fund, a growth buyout manager. So the reason for that, James, is that they're a buyout manager because they take control of businesses. So they acquire normally more than 50% of the businesses, and therefore have significant influence on the way those businesses are run. However, they are growth orientated. I don't have the numbers to hand. It's probably on their own website, but you can see that the types of sectors that they're subsectors they're investing in within enterprise software are very fast growing, both from a revenue and an EBITDA standpoint. So HG actually is one of the managers that we've been investing with and alongside for literally decades.
Now, in terms of the geographic allocations here, there's another interesting question. So there is quite a big gap now between valuations in the US and the rest of the world, and especially the UK, but just generally. Is that true in private markets as well, that the US investments are valued more highly?
Oh, that's a great question. Again, quite difficult to answer because private equity is really a micro investment business. You're investing in the companies, and I guess you would need to look at every single subsector. You'd need to look at comparisons between how that subsector is is valued on the private markets in the US and in Europe. I mean, we do have managers that invest across the globe and will think like that. You know, they'll be weighing up an investment opportunity, say in France, versus a similar investment opportunity in the US, and trying to work out which is the better opportunity. But valuation is only really part of it, the entry valuation, because along with it comes a business plan, and it comes with then the projected growth rates of those businesses. So it may well be that you pay more for a business in the US, but you're expecting more growth and a higher valuation when you exit that business. So it's very much, I mean, this is quite a painstaking and detailed business. You need to look company by company, sector by sector, geography by geography, I would say.
Okay, thank you. Now, just thinking about the sort of landscape that you're investing in, have you seen any impact from rising rates on the sorts of deals that are being done, the ability to do deals, that sort of thing?
So we're still seeing deals being done and deals being done with leverage in them. I mean, what I would say is the types of deals that we're doing, the managers that we're investing with, typically using what I would call quite modest amounts of leverage. We invest a lot in the small and mid-market part of the market. So these companies are generally not over leveraged. They're also growth orientated. And when you're investing in growth, you don't lever the companies very much because you need to be able to invest in the growth for the future. So our managers are still able to get debt for the deals that they're doing. The debt is clearly more expensive than it was a year or two ago. And therefore, in order to make the maths work, they have to be able to grow those businesses more rapidly and more strongly. So we're in the fortunate position that we're able to pick the companies that we want to invest in. So I'm talking here really about the co-investments. And we can look at those business plans. We can see the growth which is being projected. We can see the, how that value is going to be created in the future. And therefore we can pick the deals that we think are going to be able to be more resistant in this particular environment. So just to give you, giving a couple of examples, we like businesses where there is pricing power, where the companies are able to raise prices because of inflation and where they're able to get those price increases through. So often this will be in sort of must-have products and services. So think about, enterprise software where your clients are depending on accounting software, legal software, and you are able to get price increases through. Think about also sectors of the market which are highly fragmented and where you can create a lot of value by investing in a platform business and then by making lots of acquisitions of smaller businesses, usually at much lower entry multiples, consolidating that particular market sector, and then being able to sell on in, say, 5 years' time to a bigger industry consolidator. So there are still lots of opportunities in this sector, in this market. And I would say that actually dislocation and disruption is actually good for private equity because it's flexible, nimble, and can seek out those micro opportunities. We actually think this environment is a good one to be doing deals in.
Okay. I mean, you've got a relatively low, I mean, I know that's only half a year, actually, fair enough. So, but we are sort of looking at levels back to 2020 levels in terms of cash flows.
That is, actually, James, that is actually a full year. That's the full year to May.
Okay, fair enough.
It's probably not very clear, but this is our financial year as
Right,
opposed to a calendar year. So yes, it's a lower level than we normally see in terms of net cash flow.
But do you think that the sort of pace of deals, and I guess the cash flow, is going to pick up now?
So I think it's still, I wish I had a crystal ball, is the real answer. I think that things will start to get better because I think up until quite recently, people have been very worried about the direction of travel of inflation, of interest rates, and that's acted as a dampener on the whole M&A market. So, where there's uncertainty, where there is concern about where inflation is going to bottom out, for example, it's much harder to bid for companies. And therefore, new deal activity right across the board has been pretty slow for the last sort of 12 to 18 months. I would say it's starting to pick up, although you can't really see it in the numbers yet. I referred earlier to the fact that there is quite a lot of money in larger private equity funds, mega funds, who've been sitting a little bit on the sidelines, but they've raised large amounts of capital over the last 2 or 3 years. That money will start to get deployed. And because we're targeting more of the mid-market, some of our companies in our portfolio could get acquired by those bigger private equity funds. Equally, I think we'll start to see strategic buyers really come back. I mean, we've had some good strategic sales, but not many of them, over the last sort of 6 to 12 months.
In terms of discounts now across the sector, how much do you think that's a factor? It's quite hard to see what the direct relationship is, but how much do you think of it is related to interest rates? And if interest rates have peaked or are about to peak, do you think that might be about to change?
Gosh, that's another very good question. Another one where ideally I'd like my crystal ball. But I would say, I mean, the whole sector's got derated. I think part of it is, the kind of the risk off sort of attitude that we've seen over the last few months, and we've seen it right across public markets. And rightly or wrongly, private equity has been considered more risky. I mean, I would refer to that number I showed earlier, which shows our loss ratio is extremely low, actually. And we've been able to generate good returns through lots of different macroeconomic cycles. And I think our peers are probably in a similar position. So I think there's been a bit of a risk-off attitude, which has definitely impacted the whole sector. I also think there's been a bit of confusion and some myths as well that people sort of cling to. So confusion between venture capital and private equity. And, the venture valuations really did go through the roof in 2021. And in fact, people were saying to us at that stage, why do you only have 3% in venture? Why don't you do more? So you can't please people all of the time. But, venture had a huge, increase in valuations, then came back down to earth. Private equity has been much more sort of steady eddy. So I think there's a bit of confusion about that. I think also there's been concern about, what happened in the great financial crisis. Private equity had some issues at that point. But what people don't realize is how much the sector has changed over the last 15 years. I mean, I talked about our own industry sectors that we invest in and how we're now, 51%, 52% in healthcare and information technology. That, across the sector, the exposure to consumer discretionary is really small. So it's very different to where we were in the GFC, where you had a lot of kind of consumer discretionary businesses being backed by private equity that really suffered in that environment. So I think there's that. And I think also that if I look at the listed private equity sector and the peers, we're all in pretty good shape now, compared to 15 years ago, where, arguably there might have been sort of mismatch between commitments and financing, and maybe there was some overcommitments. So I think the whole sector is actually in a much better spot, but people have long memories and they're thinking back to the GFC.
Yeah, I think that's probably it as well. Just a point of clarification, when you've got exits, do you ever hold on to things that are listed, or do you sell immediately on when they IPO? Or
that's another great question. So we don't really want to hold public stock because we are a private equity vehicle, but sometimes we will be under lockup provisions. So when a company goes public, if we've got direct shares, we will be subject to the same provisions that the manager is. So it might be a 9-month lockup, 12-month lockup. So we can't sell immediately. But in general, in any case, when we've got public shares, what we would like to do is to sell down at the same rate, the same quantities proportionately as the private equity manager, because they know the company best. And so we'll move in lockstep with them. But the idea is not to keep holding those public stock. It is to liquidate really as soon as we can.
there's a specific question about a specific company called Olaplex, so you didn't necessarily have to answer that. I know it might be difficult, but questioning whether you'd hung on to it because of the share price had dived. But say you did have a stock that had IPO'd and you still were locked into it, would you ever hold it for a recovery, even post the end of a lockup, or?
We would do exactly what the manager does. So if it's a co-investment, so we've got direct holding in that company, then as the manager sells down, we'll sell down at the same rhythm. So if that takes us beyond the lockup period, then yes, we'll wait for the manager to exit, and then we'll exit at the same time. Now, I can't really talk about Olaplex. It is a public company, but we actually don't hold that company directly. It was actually through a fund. So when it's held through a fund, it's the manager that's totally in charge of exiting that business.
Okay, cool. Again, another sort of big picture question for the sector. Part of the reason that people seem to be anti, if you like, private equity is the fees thing. And we've got this problem across the whole industry in terms of what the FCA is making us disclose in terms of fees and funds and that sort of stuff. Is there anything that you can do on that, or you think you need to do on that? Are you comfortable where your ongoing charges number is, and do you think people actually understand what the true costs are?
Yeah, I mean, the ongoing charge, I mean, the AIC number, I think it's in the annual report. It's 1.25%, which is is pretty much sort of on par, even I think a little bit better for the sector. So that's the sort of the headline charge. I think what people get worried about is this look through, which we find a bit perverse, because this will then relate to the fund part of the portfolio. So as I've said, that's been reducing. It's now 48% of what we do. But perversely, because it covers both the management fee and the carried interest, which is paid to the underlying manager, then the better the manager does, say they knock the ball out of the park and they get a kind of a 10 times cost or something on their fund, and then they're entitled to a lot of carried interest, then even though we've received a fantastic return from that fund, and that will be a net return, net of all the fees and everything else, we will have to report a high look-through charge because the carried interest, it's paid for performance, so the carried interest will be high. So it's a bit perverse, because I think the better an underlying fund does, the higher the look-through charge we have to report. But the performance that we're reporting is actually net of everything. So that 12% annualized NAV growth is net of all fees and costs. So it feels a little bit perverse to us. I mean, we've had discussions with a number of people in the sector. I know it's a big topic of conversation at the moment, but it just feels a little bit odd to be doing this.
Yeah, I agree. Good. Well, thank you very much indeed for that. That's really helpful. We covered an awful lot of ground. I hope it was useful for you too. And we'll get you back again in a year or so.
Thank you very much indeed. Thanks for all the questions as well.
Thank you.
Thanks. Bye-bye.
So we're back next week. Richard's going to be talking to Richard Moffat from Urban Logistics, and then the week after we've got Shire's Income, which is one of the companies that's engaged in this sort of merger frenzy. I have asked if GCP can come on the 1st of September, where we've got the slot free there. We'll have to wait and see if the lawyers let them come, but fingers crossed. I think it'd be good to get the rationale for the merger from the horse's mouth. And then the week after, it's a show for White Oak Emerging Markets, which is obviously one of the newest funds on the block. So thanks very much for listening today. Hope you enjoyed it, and have a good weekend, and we'll see you next week.